If you only have $100 to start investing in 2025, stay with me until the end of this video. I'm going to show you exactly what I would do if I were in your shoes. Step by step, with real practical strategies accessible to anyone. And more, I'll reveal how to turn that $100 into a solid foundation for your financial future, even if you're starting from zero. Before we continue, make sure to leave a like and subscribe to the channel. That way you'll get exclusive content that will help you grow financially, no fluff, and with real results. Let's go. Starting to invest with little money might seem challenging. I know. But what most people don't understand is that financial success doesn't depend on the initial amount, but on the strategy and mindset. What matters is taking the first step with discipline, focus, and the right information. I'll break down this journey into clear steps so you know exactly where to put every cent, how to protect yourself, and how to make your money work for you. No miracles or false promises. So pay attention, because what's coming next might change how you handle money forever. First, it's important to understand that investing isn't a scheme to get rich overnight. It's a gradual process that requires patience and consistency. Compound interest, the famous snowball effect, only works if you keep your money invested and continue to add to it regularly. Now imagine you have those $100. What would you do? I'd start by investing in financial education. It might sound cliche, but understanding the basics about finances, investment types, risks, and opportunities is what will give you confidence to move forward. With that foundation, the next step is to open an account at a reliable brokerage that allows investing with low costs and small amounts. Today, there are many options in the market that make it easy for small investors to get started. After that, I'd prioritize investments with good liquidity and low costs, like ETFs, exchange-traded funds, which replicate the performance of a diversified portfolio of stocks or bonds. This lets you start small and already get market exposure. But beware. Before putting your money into any application, it's essential to guarantee you have an emergency fund. This prevents unforeseen events from forcing you to withdraw investments at the wrong time, hurting your results. Building that emergency fund is possible even starting small. Set aside a fixed amount monthly, put it in conservative investments, and gradually increase it until you have at least 3 months of expenses saved. Meanwhile, keep investing those $100 or more into assets that can grow in the medium and long term. The discipline to keep adding money is what makes the difference. Remember, diversification is essential. Even with little money, try to split your investments among different assets like fixed income, stocks, and real estate funds to balance risk and return. Another crucial point is mindset. Investing stirs strong emotions. Fear and greed are powerful enemies. You need to develop emotional discipline to avoid impulsive decisions based on news or trends. Have a clear plan, stick to your strategy, and keep your focus on the long term. Learn to handle the market's ups and downs because they're natural and temporary. Avoid common mistakes like investing without planning, following unreliable tips, or expecting fast profits. Success comes with time, knowledge, and consistency. To ease your journey, use digital tools. Nowadays, there are many apps and platforms that help you track your portfolio, control spending, and even suggest investments suited to your profile. These tools make the process simple and transparent, giving you more confidence in your decisions. Now, if you want to speed up your learning, there's a spreadsheet I use to control my investments, with analyses and projections that help monitoring. The link is in the description. Check it out to take a step further. If you apply these strategies, even starting with $100, you'll be building a solid foundation for your financial independence. The secret lies in discipline and planning. If you really want to stand out as an investor, the first big step isn't tools, assets, or how much money you have. It's your mind. The mindset of a successful investor will determine whether you grow in the market or miss opportunities and lose money. The truth is that investing stirs deep emotions: fear, greed, anxiety, euphoria. All these feelings can sabotage your journey if you don't know how to control them. Many people enter the market expecting to get rich fast, and when they don't see results in the first month, they get discouraged. Others, in the height of euphoria, make risky bets, buying and selling without a strategy, and end up in the red. The key here is to develop a disciplined, patient mindset focused on the long term. For this, you first need to break limiting beliefs. Those inner voices that say, investing is for rich people, I don't have enough money, or this isn't for me. These beliefs limit your actions before you even start. But the good news is, you can replace them with empowering thoughts like, it's possible to build wealth with little money, and by learning a bit every day, I will improve my financial life. Another essential point is understanding that the market has cycles. Ups and downs are part of the natural process. The smart investor doesn't panic when the market falls, nor gets greedy when it skyrockets. They stay calm, follow their plan, and seize opportunities with a clear head. Practicing patience is tough but rewarding. It's what lets you benefit from compound interest, which only really works when money stays invested for a long time. It's also important to control greed. Many want to multiply their money quickly and end up entering very risky investments or scams. The discipline to follow the defined strategy with regular contributions and timely reviews ensures solid results. Finally, keep the habit of studying and updating yourself. The mindset of a successful investor is open to constant learning, able to recognize mistakes and adjust course without losing confidence. Having this mindset is what separates those who quit at the first obstacle from those who achieve financial freedom. And believe me, it's a path anyone can take. Having an emergency fund is like having a safety net for your finances. It's the money set aside so you can face unexpected events without having to touch your investments or resort to expensive debt. Without an adequate emergency fund, any problem, like a medical expense, urgent repair, or even job loss, can disrupt your entire financial plan. The ideal fund covers between 3 to 6 months of your monthly living expenses. But for those starting with little money, building this amount might seem hard. Here's the strategy. Start small, but start now. Set aside a fixed amount, no matter how small, regularly. It can be $10, $20, or $50 per month. The important thing is to develop the habit of saving before investing. Put this money somewhere safe with easy access and daily liquidity, like a savings account, remunerated digital account, or conservative fixed income funds. The goal is to have money available quickly when needed. Building this fund brings peace of mind and allows you to invest without pressure or fear. Knowing you have a safety net prevents impulsive decisions like withdrawing investments at the worst time or going into debt. Plus, the fund gives you freedom to take slightly more risk in investments since your emergency money is protected. Over time, as your income and investments grow, you can increase the fund to the ideal amount. Diversifying your investment portfolio is fundamental for any investor, and those starting with $100 are no exception. Diversification works like a shield. When one asset performs poorly, another can balance the loss. Many people think diversification requires a lot of money, but today with ETFs, funds, and fractional investing platforms, you can build a diversified portfolio even with small amounts. Start by choosing different asset classes, fixed income, equities, real estate funds, and even cryptocurrencies respecting your risk profile. For example, you can allocate 50% in ETFs tracking the stock market, 30% in fixed income bonds, and 20% in real estate funds for passive income. This mix helps balance growth and safety, avoiding large losses during crises. It's also important to vary economic sectors and geographic regions. This way, you're not exposed to just one economy or industry. Diversifying isn't just buying a little bit of everything, but planning intelligently to protect your wealth and maximize gains. One of the most common mistakes is investing on impulse, influenced by trends, hot tips, or momentary emotions. This can lead you to buy stocks at their peak or enter funds promising exaggerated returns with high risk. Another mistake is not planning. Investing without clear goals, timelines, and risk profiles is like sailing without a destination. The risk of losing money is much higher. Not reviewing your portfolio regularly also hurts progress. The market changes, your profile changes, but many people keep the same portfolio without adjustments, taking unnecessary risks. Ignoring costs and fees is a big error too. Brokerage fees, management fees, and taxes can eat into your returns, especially when investments are small. Lastly, lack of patience and discipline is one of the main reasons for failure. Investing isn't a game of luck, and quitting early can cost you dearly in the future. Avoiding these mistakes is possible with information, planning, and discipline, which you're already building right now. Technology is a key ally for beginner investors. Today, there are dozens of apps, platforms, and spreadsheets that make it easier to control, track, and even analyze your investments. Brokerages offer intuitive dashboards where you see your balance, returns, and diversification in real time. Personal finance apps help monitor spending and set money aside for investing. Some platforms even notify you when your portfolio is off balance and suggest adjustments. A real help for beginners. Using personalized spreadsheets also helps control contributions, track returns, and simulate future scenarios to feel more secure in your decisions. Plus, websites and apps provide market news and analysis so you stay informed without wasting time. But beware of information overload that causes confusion. Choose reliable tools you can use easily. With these tools, investing with $100 stops being scary and becomes simple, transparent, and effective.